steps. Step number one, we must understand what type of market we're dealing with. There are three main types of markets in the United States and around the world: cyclical markets, linear markets, and something right in between, a hybrid market. And we're going to dive in deeper so you understand exactly what market you're living in or where you're considering purchasing a home or selling a home. Before we get there, let's look at a chart of the U.S. home prices adjusted for inflation. Just going back to 1999, this time we don't have to go all the way back to 1900 or the late 1800s like I typically do. Because if you look at the historic trend line, it bottoms out right around 1999. So we'll start there. Takes us to today, 2020. This is an index chart. So it starts at 100. It doesn't imply that home prices were $100,000. And it goes up to around 170, 160 or so at the peak of the bubble in 2006. Of course, we come crashing down to 2012, and we go right back almost to where we were. There's a small delta, small gap if you look at U.S. home prices as a whole. But if you look at individual markets, some markets are even higher, the same, and lower. So let's go right into that so you can determine if you live in a linear market, a cyclical market, or a hybrid market. The definition of a cyclical market and a linear market, very straightforward, easy to understand. A cyclical market is one that goes way up in a boom and comes crashing down in a bust. Linear market pretty much stays the same, kind of boring, and a hybrid market is right in between. Let's look at specific examples. And with this video, guys, I want to be very clear, not really geared toward the investor. This is really geared toward the homeowner. So this is the home where your family lives. Do you want to buy one? Do you want to sell one? It's geared toward your home, not necessarily a rental property or a flip. So getting into it, examples of cyclical markets. Let's start with San Francisco. Same type of chart, adjusted for inflation, indexed. Goes way up, 83% higher than where it starts, and of course comes crashing down. Today, prices are almost as high as they were in 2006. Let's go over to Seattle, another cyclical market that is even higher than it was in 2006. Back in 2006, it got to the point of 155, call it. Now it's close to 170. Next, let's go to Denver. And Denver was a hybrid market where prices would go up a little, come down a little, but since so many people have been moving there, the prices have gone up dramatically since their low in 2012 to now it might even be considered a cyclical market. And the big problem with these markets is as they go up, it's fantastic, but when the market starts to turn, there's a big delta between the current price and where the price will most likely bottom out. Moving on to the linear markets, we'll start with Charlotte, a perfect example of what I'm talking about. It looks like the prices barely even move compared to the cyclical markets, going up to around 108 and then down to maybe 80 or so, and right back to its historic norm in January of 2017, and we've just gone up a little since then. Moving on to Dallas. This is a market that stays pretty much the same. We've had a lot of people moving there, but I want to point out that the prices have pretty much flattened out because although you have an increase of population and growth due to businesses all moving there from higher tax states, you've got very relaxed building codes. So it's easy for builders to create more supply to meet the additional demand. That creates prices that really flatten out and don't go skyrocketing to the moon like we see in California or some places on the West Coast or the East Coast. And Cleveland, a linear market for sure, went down and it's pretty much stayed flat. It's on a slight upward trend, so it'll probably get back to its historic norm in maybe 5 or 10 years, but not a lot of price movements here. You're definitely not going to see huge appreciation in a market like Cleveland. Now that you understand what type of market you live in, there's kind of a golden rule that we can live by, where if you crunch all the numbers, you see that if you're buying a home that's over $250,000, $300,000 for sure, usually financially, I'm not talking about how to make the wife or the husband happy or the kids or to have any long-term security or something that makes you sleep well at night. Those are all extraneous factors that you need to decide on your own. But just when you're crunching the numbers as if the decision was exclusively a spreadsheet, you can say that if you're over 250 or 300,000, usually it's a better deal to rent than it is to buy. Anything under $250,000, and normally that's a better financial decision to buy. Step number 2, should you sell your home or should you wait? This is specifically aimed at people who thought about selling their house prior to the cerveza sickness. This isn't really saying if you've never ever thought about selling your house, maybe now is the time to do so. Just aimed for people who maybe thought about selling their house. Is now a good time? Maybe we're moving and now they're saying to themselves, geez, I don't know if I should sell my house now or maybe wait till this whole cerveza sickness is in the rearview mirror. Specifically geared toward those people. So let's dive right in. Now we've got the chart going back to 1900, of course, and I'm not going to go into it in great detail. You guys know this chart well. But what you might not have seen before is this chart when you lay over a chart of nominal home prices. Look at the difference. This is why I always tell people, especially when you're looking at real estate, you have to look at inflation-adjusted prices. Most of these YouTube gurus that talk about real estate investing usually just use nominal charts. Well, of course, it makes sense. They're trying to prove their point that real estate always goes up in price over time. Cough, Dave Ramsey. So when Dave Ramsey, as an example, is talking about the housing market, he is only going to use inflation-adjusted prices. Because if he were to adjust for inflation, the way you should, because it's all about purchasing power, it goes to show that home prices really don't appreciate over time. They really just inflate. In other words, they really just go up with the rate of inflation. And you could point out a chart of San Francisco and say, look at this, George. My home price has gone up to $1 million, $2 million in the last 5 years or 6 years. And I would say, okay, that's great, but let's just wait another 10 years and see if it goes back down or if it goes back up another $1 million. My bet is it goes right back down to its historical mean. And looking at this chart, I think the odds are definitely on my side. But some of the rebuttals that you have are, George, look at the 1970s. Home prices really went up. And again, yes, in nominal terms, they did go up dramatically. But adjusted for inflation, they really only went up in the late stages of the 1970s. And I'd like to point out that's starting from a base of a historic norm. Right now, we're starting at a base of an all-time high. So there's a big difference between starting at a very low point and starting at a high point. It goes back to buying things when they're cheap or they're expensive. I always say that it's better to buy low and sell high instead of trying to buy high and sell higher. The next rebuttal I always hear is, yes, George, but lending standards now are so much better. I mean, my goodness, back in 2004, 2005, they were just giving loans away to anybody that could fog a mirror. Now, lending standards are pretty strict. So I don't see a lot of downside to the housing market. I see that inflation-adjusted chart you always use, but no, I think prices are going to infinity and beyond because the lending standards are just rock solid right now. Okay, fair enough. Editor, throw up the chart. What we can see is that's pretty much fake news. When you go back and look at the lending standards, 2003, 2004, 2005, the average down payment was right around 6%. It did go down dramatically in 2006, but that was just for the 1 year, right when the bubble was at its peak. And then it dropped way down in 2009 because of all the government programs trying to prop up the housing market. But look at where it is back in 2015, 16. My guess is it would be very similar today, right around 6%. The exact same down payment on average that was required 2003, 2004, 2005 as that bubble was growing and growing in size. The lending standards are pretty much identical. It's just one of those things that so many people hear it, they say it, and since so many people say it over and over and over again, we just take it to be true without actually looking at the data. But that's what I'm here for. You guys keep watching the videos, I'll give you the data, and I'll smash the fake news for you. I think you honestly need to assess what your upside is versus your downside. Look at the fundamentals. What could possibly drive prices higher? Are interest rates going to go down a lot? Probably not. They're already at zero. Are we going to see tremendous real wage growth that would give consumers more purchasing power? Again, probably not. Real wages have been stagnant for the last couple decades. True, they have increased slightly over the last couple years, but if you look at a chart going back 20 years, they're almost flat. Then we need to insert the cerveza sickness. Jobless claims last week alone were 6.6 million. So what are the chances people's purchasing power increases over the next year? Also, we have to go back to the old investment mindset. And I know this is your primary home, so I get it. But you still, if we're just looking at the numbers, we're just looking at this as a spreadsheet, we've got to consider that side of it. So ask yourself, is your home right now cheap or is it expensive? And as you know, when things are cheap, we buy them. When they're expensive, we sell them. And especially if you're in a cyclical or a hybrid market, looking at the charts that we brought up in step number 1, the conclusion is most likely it's pretty expensive. Finally, you need to consider asymmetry. So even if you came to the conclusion that there's a 50% chance that prices go up in real terms, a 50% chance that they go down. Okay, if they go up, by how much? Are they going to go up by 100%, 200%, or 10%? And if they go down, are they going to go down by 20% or 50%? Like they did in 2009 to 2012, going back to their historic trend line, or down by maybe 60% like they did in Japan from 1990 to 2005. You always have to remember that over time, home prices tend to mean revert in every single market, regardless of whether they're cyclical, linear, or hybrid. Why is that? Because wages typically stay pretty consistent with inflation. Wages are what you use to buy a home. Therefore, it makes sense that home prices pretty much stay consistent with inflation. If not at a national level, definitely on a local level. The main takeaway for step number 2 is if you live in a cyclical market and you've thought about selling prior to the cerveza sickness, you should definitely sell now. I can't see any upside in waiting. Same exact thing for a hybrid market. If you live in a linear market and you have a home that's under $250,000, maybe $150,000, $175,000, I'd be 50-50. I wouldn't have that rush to urgency to sell right away. I might think about it a little bit longer. But my main point is with a cyclical market and a hybrid, I would hit the bid right now. I think it's a complete no-brainer. But I want to add one more kind of curveball. And if you have 100% equity in your home, you might consider, and I know this isn't right for everybody, and I don't like a lot of debt. I definitely don't like consumer debt. But it may be right for some individuals that have 100% equity in their home. They own it outright. If you're one of those people and you might want some dry powder to invest in other assets that may become really cheap over the next year with a recession or a depression, or if you're someone that might be a little hesitant about losing your job, it might be a good idea to take out some of that equity right now so you've got some cash. So if you do lose your job, you've got a little to live on. Or if you're not worried about your income whatsoever, you might have some dry powder to take advantage of very cheap assets on a moving forward basis. Again, I want to be very clear. I'm not suggesting everyone use their house as an ATM machine. It's not it at all. I'm just saying, hey, listen, here's an idea that maybe if you don't want to sell, if you come to that conclusion, but you need cash, whether it's for dry powder or because you're a little hesitant of losing your job, then this may be an option to consider. Step number 3, should you buy a home now or should you wait? This is for the people who thought about buying a home prior to the cerveza sickness. Maybe they're thinking about buying a home now, but they're like, boy, I don't know, with what's coming down the pipeline, should I really pull the trigger? If I was in your shoes, what I would be asking myself first and foremost, what are the RV ratios? We all know what those are. I've been talking about them in all of my real estate videos. That's the amount of rent you can collect per month compared to the amount of money you have in the property. And I understand this video is geared towards home owners, not real estate investors. But even a home owner should consider that first, in my opinion. So look at the RV ratio. If it's under 1, then it might be a better deal to rent. It goes back to what we were saying with the cyclical, hybrid, and linear market, and a home being under $250,000 in value. The reason that's kind of a benchmark is usually when you get over the 250, 300, it's really tough to find a home with an RV ratio of over 1. But under $250,000, that's usually where those deals exist. So again, if you can find an RV ratio of over 1, it's probably better to buy. If the RV ratio is quite a bit lower than 1, 0.4, 0.5, it's a much better financial decision to rent. Next, we've got to consider the cost of the mortgage. Of course, interest rates are extraordinarily low, 5,000 year lows. So if you can lock in a fixed rate interest 30-year mortgage, it might be wise to do that if all the other conditions line up. I'm not saying go out and buy that penthouse in New York for $10 million because you can get a cheap loan. That's not what I'm saying at all. And the third component, which I think is extremely important and most people overlook, is the cost of construction. To understand this further, let's go to my full-length interview with real estate expert and my good buddy, Jason Hartman. How do I determine if something is cheap right now or if it's a better deal right now?
With real estate, improved real estate we're talking about, one way you know if it's cheap is if the ingredients and the assembly of those ingredients cost more or about the price you're paying. Basically, the cost of all the raw materials, and you got to think of what are the ingredients of a house. There are copper wire, petroleum products, and look at how cheap oil is right now, right? Energy in general, lumber, concrete, steel, glass, all of these items are ingredients of a house, plus the labor to assemble them, right? And the labor may be cheap or expensive at the time. So If you're buying a house at or close or below, ideally, the cost of construction, which depends on where you are, you're probably pretty okay in terms of the cost of construction approach.
Yeah,
Okay.
long term, right? Yeah,
Yeah.
got it.
Yeah, you're going to be fine, especially with a cheap debt.
So you may be asking yourself, okay, where is the general cost of construction right now? Let's look at the United States as a whole. Going back to 2005 all the way to today's date, it starts, this is an index chart, so it indexes to 2017. That's our starting point, 100. So 2005, it was around 85, went up to 90, pretty flat. Of course, when housing prices crashed in 2006-ish all the way down to 2012, we see this downtrend in the cost, the building cost. That would make sense. Labor costs go down. Materials probably didn't change much, but labor is what changed a lot, and the price of the land. 2012, when we hit the bottom, we start to quote unquote recover. I don't like that word because I don't think prices recovered. They're just reinflated. So when prices reinflate, so does the cost of construction, taking us to where we are today, 2020, around 115. So that chart showed us trends of what's been happening in the United States, but it doesn't really show us specific dollar amounts broken down by where you live. So to understand that further, let's go straight to the internet. This is a fantastic website, a great resource I found when I was doing research for this video. So I'll put a link in the description below to this specific web page. But we start with looking at what the cost of construction is by region. So the South, around $100, going up to the Northeast, which is $155 per square foot. It also gives us the breakdown of what it costs for each segment of building a home. So the foundation, framing, exterior, interior finishes, final steps, etc. I also wanted to point out that all homes are not created equal from a standpoint of cost per square foot. When we look at $100 a square foot to build or $150 a square foot to build, that's a very basic, just kind of a starter home. Once we get into the custom finishes, that's where the per square foot cost really goes through the roof. And you can see that on this spreadsheet. For a 1,500 square foot home on the lower end, just straightforward, $100 a square foot, $150,000, going all the way up to $600,000 for the same size home. The finishes really make a big difference. Whoa, time out. I got a quick bonus for you guys. I know it's kind of off topic, but I saw it on this website, and I think a lot of you watching this video will really love this information. What does it cost to build a shipping container home? Pretty cool, huh? A shipping container home, you can build it for between 60 and 90 grand, maybe a little bit bigger, 150 to 175. Also, how about a tiny house? Those are super popular now. A super tiny house looks like you can build it between $25,000 and $35,000. Wow. And maybe a small house, I guess that's a little bit bigger than a tiny house, about 600 square feet. You can build that for about $50,000 to $70,000. Really a cool idea, and especially now when we're going through the cerveza sickness and maybe budgets are tight and maybe we want to kind of get out from these urban areas, considering something like a tiny home like this right here. Check out how cool that looks. That might be a really neat alternative. So should you buy a home or wait? Well, if you're in a cyclical market or a hybrid market, definitely wait. Do not pull the trigger right now. And this isn't investment advice. Again, I'm telling you what I would do or I would suggest to my friends and family member. But there is no way I would buy a house right now in a cyclical market or a hybrid market. I'm a renter 100%. A linear market? That's a little tougher. It's 50-50, just like step number 2. I see a reason maybe you'd want to buy because debt's so cheap. I also see a reason why you might want to hold off. But I think it goes back to looking at the RV ratio. And if you can get a house with a great RV ratio, that means it's a better deal to buy. And then finally, of course, and this would probably be my main consideration, would be the cost of construction. If I can get a house in a linear market and buy it far under the cost of construction, and it's not in the ghetto, it's in a great area, great schools, it's where you really want to live, then I would consider pulling the trigger. But only if I could get super cheap debt, if I could get a 30-year fixed rate loan. For more content that'll help you build wealth and thrive in a world of out of control central banks and big governments, check out this playlist right here, and I will see you on the next video.